This video is not going to get a lot of views, so if you're watching it, that already means that you are ahead of the curve, but it's important that you stay ahead. I'm going to be discussing a couple strategies to mitigate impermanent loss within your positions, also known as divergence loss, and this is going to allow you to make more money. Simple as that. Now guys, if you're new here, I'm an avid DeFi investor. I've been investing into DeFi since 2021, and I've been full-time in crypto since 2020. My first year in DeFi, I did $81,000 in yield, and I only paid roughly $14,000 in overall expenses, gas fees, total fees, stuff along those lines. I'm also currently doing a 130% APR as well as $5,000 per month from one of my portfolios, and then another 568% APR and $7,000 per month from a smaller one of my portfolios. And I've helped over 200 people in a one-on-one setting do the exact same thing through my company Builder Wealth. And if you guys want to learn more about that, or you need some more help with your DeFi portfolio, or you want to implement these strategies that I'm going to be talking about today, the link is right below this video. But with that being said, it's time to talk about mitigating impermanent loss. And for those of you that don't know what impermanent loss is, I like to refer to it as divergence loss or even opportunity cost, because ultimately it is a form of opportunity cost basically. Essentially, it represents if we held our assets in the market compared to holding our assets in the liquidity pool. And the reason why is because if we're in, say, Ethereum and USDC, ultimately, as the price of Ethereum goes up, we start to sell our Ethereum into USDC because people are buying that and they are giving us USDC, which means that we're dollar cost averaging or laddering out of Ethereum as the price goes up, ultimately meaning that we are going to have some divergence loss or opportunity cost. And the simple way to show you this is I currently have $8,197 in my sold to USDC liquidity pool. This number, this $8,200 nearly, is the initial assets appreciating. This is not compounding. This is not including earnings. This is saying, hey, I deposited $8,050 and I currently have nearly $8,200. Now, if we scroll down a little bit over on the metrics finance tracker, you'll see this divergence loss section. And this is benchmarking our position basically. We have a couple different benchmarks right here. Number one is our initial assets. It's saying, hey, Jake, if you stuck your money in, say, Sol as well as USDC, instead of putting it in a liquidity pool, and you stuck it in the 49-51% ratio that you started this liquidity pool with, today you would have $8,250. Instead, in a liquidity pool, you have $8,200. So in this instance, your divergence loss is $53. You have $53 of opportunity cost, right? You have $53 less compared to holding your money just spot in a wallet, right? Not even bothering with liquidity pools. But in liquidity pools, you have a little bit less because your assets are being sold. I started with 49% and 51%. I now have 72% and 28%. It's the selling of my assets basically between each other, creating divergence. Well, the beauty of this is obviously you can use fees to outweigh this divergence loss, right? We have $53 of divergence loss or opportunity cost, but then when we add the total of $444 in overall income from this position, we are beating that benchmark by $391. And this one represents if we held a 50-50 ratio. This one represents if we stuck it all in USDC. This one represents if we stuck it all in Solana. So that's the very basics of divergence loss, opportunity cost. When it comes to mitigating that divergence loss, impermanent loss, whatever you want to call it, guys, I'm going to start to refer to it as divergence loss in this video. Now, most people think that in order to mitigate this impermanent loss, you just have to be good at liquidity pools. And I'm here to tell you that that's not the case, right? Anybody can do this. And ultimately, it doesn't come down to any advanced strategies. We don't have this crazy technical brain or this quantitative data point, right? What we do is we look at the pools before we enter them. Simple as that. And we make sure that we are invested into pools that are going to make sense. It is as simple as that. Making any other investment, right? If you're looking for a cash flowing investment, let's just say you're investing into a company for dividends, right? Ultimately, you're going to say, okay, I got, let's just say, $10,000 to invest in this company. And you invest your $10,000 into this company and it's doing, say, a 15% dividend APR, right? And you're like, okay, well, the max drawdown that I could see over a period of time is going to be, let's just say, down 25% over the course of 6 months. Well, ultimately, if you could go down 25% over the course of 6 months, you have to see how likely is this to happen because it's going to take a while for your 15% APR, which keep in mind is 15% per year, to outweigh that negative 25%, right? So you have to look at it that way. You have to look at things before you actually dive into the pools. So it all comes down to pool structure. And when I look at pool structure, I'm looking at number one, the actual assets in the liquidity pool and if they are correlated. So this is number one right here. If we don't have correlation in our assets within the liquidity pools, it is highly likely that we are going to get wrecked by divergence loss. And the reason why is because there's just simply more divergence. If we are pairing, say, ETH and USDC together, ultimately USDC USDC will stay at $1, whereas ETH might range between $3,000 and $4,000. And say you start at 3,200, well, if ETH goes down to 3,000, you're not going to have as much divergence loss. But if ETH goes up to $4,000, you're going to have a ton of divergence loss because you diverged, right? Ethereum went up a ton, USDC stayed the same, meaning that these prices saw divergence. Now, in the instance where we actually have, say, an Ethereum wrapped Bitcoin liquidity pool, and let's just say in this instance, both assets go up 10%. They do really, really well one day. Ultimately, we're going to see no divergence loss in this liquidity pools because there's absolutely no divergence. Whereas let's just say we are in ETH BTC and all of a sudden Bitcoin decides, okay, I'm going to go up 5% today. And ETH turns around and says, hey, I'm a more volatile cryptocurrency. I'm going to go up 15% today. Ultimately, there is some divergence right here. We're going to lose some Ethereum exposure and we're going to gain some Bitcoin exposure because people are trading Ethereum for Bitcoin, which is why it's doing better. So ultimately, we will end up with a little bit more of Bitcoin because there's more divergence here, basically. So if we look for correlated pairs that are going to rise and fall together, say one goes up 10%, the other goes up 10%, one goes down 10%, the other goes down 10%, well, then that's already going to help us off the bat. Now, obviously, they don't have to hit the exact same numbers. That's near impossible. They need to be similar numbers. They need to have correlation. And on Metrics Finance, you can actually see that. If I were to go over here to this PIS Sol liquidity pool that I'm currently in, these are going to have some form of correlation. Now, recently, that correlation is going to be broken. And the reason why is because Sol saw a huge jump. So it broke that correlation. But if we even look at the past, say, 2 days, you'll notice that these have a 96% correlation right here, which means when one's going up, the other one's going up. When the other one's going down, the other one's going down, right? They're both going down, they're both going up at the same time, and they're doing similar numbers. So they're not really seeing much divergence. Now, once again, there are going to be times where you see Sol perform very, very well, or Pith perform very, very well, and there will be divergence right there. So again, correlation is going to be the first thing, which comes into just deploying into crypto to crypto liquidity pools as opposed to crypto to stable liquidity pools. Next thing is going to be getting your rebalancing on lock, right? This goes into position structure, and obviously we need to look at range and everything like that. But ultimately, before we invest into a position, we should always be diving into position performance. Like, okay, what happens if Sol were to go up to 265, yet Pith were to go up to, let's just say 60 cents, right? So obviously, or maybe more realistically, like 50 cents. There's some divergence right here. There's 17.5% of divergence loss. In this case scenario, we will need roughly 50 days of an active position to cover this divergence loss. Now, in this instance, it just simply does not make sense to be in this position because you need so many days to cover any opportunity cost. And if Pith can go up, let's just say 55% over the course of a couple days, well then, guess what? It's going to be hard to outweigh that divergence loss. But what happens if it takes Pith, let's just say a month to go up this much? Well, ultimately, it takes Pith a month to go up 56%. We have 17.5% divergence. We can cover that within 50 days. That's not as bad. And this is a very, very unrealistic circumstance. More realistically, is going to be Pith going up 25% while Sol's going up 3.5%. And in that instance, it creates 5% of divergence loss. You need 12% of an active position, days in active position, to cover this divergence loss. And in this instance, I think that's completely fine because I think it would take probably about a week for Pith to go up 25%. And obviously, there's going to be some leeway where we're just collecting fees no matter what in there. And ultimately, as you can see, we stay in range. We're able to profit against divergence loss after 12 days. We go from having that much divergence loss to all of a sudden breaking even if we've been in the pool for 12 days or a little bit over. So that's the second thing, simulate. The third thing is going to be rebalances. Rebalances, you need to have these things on lock. The best time to rebalance is at the exact price that you entered at. It's simple as that, right? Because if we are in this liquidity pool and say we enter, let's just say right here on this dip, and then all of a sudden it goes down, we will have divergence loss during this period where it's going down. And as it's going back up, we'll start to retrace that divergence loss because we entered at around the same price. That's what we have to be aware of. If we exit at the same exact price that we entered at, that says, hey, there was some divergence, but ultimately that divergence was impermanent. That's where they get the term impermanent loss from, because the price went back to what you started at. And then you can rebalance your position with minimal divergence loss. So that's why I like to rebalance my positions before they go out of range as opposed to after. If I'm rebalancing over here, I have less divergence loss. And if it's clear that the trend is saying, hey, the price is going up, we're going to go out of range soon, I'm broadening my range to make sure that I have lower divergence loss in the future. Also, when I go out of range, I'm not instantly going to rebalance my position. I'm always going to wait 24 to 48 hours to see if there's going to be a retracement within the market. And if there is a retracement with the market, I'm finalizing my position, rebalancing at a better price as opposed to a worse price. Now, the next thing that you have to realize about divergence loss is sometimes you have to suck it up. And this is very, very important. There's so many different strategies that you can do here. And also, sometimes positions will show that you have a lot of divergence loss, but it will net it out, basically. For example, if we were to rebalance multiple times and then go back down to our initial entry price, right, we might have a similar amount of assets, right? And the other thing is we also have to kind of cover that divergence loss by investing more capital or investing some of the fees that we earned back into the position. So that way we're covering it and our assets aren't always bleeding. Now, when I'm referring to suck it up, what I'm talking about is sometimes you will be in, say in this instance, sold to USDC this time, and you have a range of say 230 to 300, and you enter when SOL is at, let's just say 245. Ultimately, you're expecting SOL to go up to 300 or near the 300 mark, and then you're going to rebalance. But it doesn't go your way, right? Because we don't have a magic ball. You probably don't have a magic ball. If you do, maybe you can license it to me. I'd be happy to bring it into our community, right? I'd pay you a nice hefty fee. But ultimately, we don't have a magic ball. That's what I'm getting at. And then this goes down to 230, or this goes down to 220, let's just say. And now you're stuck. All of your money in SOL no longer earning fees. And the reason why is because your USDC was used to buy SOL. People were taking the USDC out of the liquidity pool and giving you SOL. That's what pushed it down to 220. Well, sometimes you need to suck it up and say, okay, I am fine being out of this position, not earning fees, but I am going to hold that SOL until we get back to 245. And what I want to go ahead and show you is exactly the effect of doing that. Let's just say that we put 10,000 bucks and sold to USDC. Once again, we go in with our range of 230 to say 300. And then ultimately we start at the price of SOL being, let's just say 245. I'm going to go ahead and manually edit it. Boom. We're not going to look at APR for now. We want to kind of just get rid of that out of our mind for this instance. We're going to simulate position performance. We're going to say what happens when SOL goes to 220. Ultimately over here, we have lost $1,000 nearly, 950 bucks or so. But with that being said, we're sitting at 41.13 SOL. Keep in mind, we started with 29.84 SOL. So we've been able to accumulate a decent amount of SOL. Now, if we take that 41.1361 SOL and we hold it back until we get to 245, we'll have $10,078. Obviously not much more. This is a $78 profit. But in the instance of you're doing this on a larger scale, or in the instance where you're starting with significantly more SOL, this can be a very, very profitable strategy. And the reason why is because we started with 10,000 bucks at our initial price of 245. We go down, we go back up to our initial price, and now all of a sudden we have a $78 profit at our initial entry price. That's not factoring in any fees. Now, the other instances, obviously, you go with a tighter range and you kind of hug your entry price. Like maybe you do 235 to 255. So when you do go back in range, you produce substantial income, and that kind of adds to that $78 profit. But let me show you another scenario. Let's just say we were to do it opposite. Say we were to start with a price range of 255 as our peak, and then over here we did 200 as our min. So we have 82% USDC and 6.9 SOL roughly, right? 10,000 bucks. If SOL goes down to $200, we will now have 44.43 SOL. We hold that until $245. Now we have a total of $10,886. We have substantially more money right here than what we started with, $886. It's an 8.86% profit. The reason why, all of this USDC was dollar cost averaged into SOL on the way down. So what I'm saying here is it doesn't always make sense to hold out your positions in just huddles, but sometimes it does. I've seen instances where I do have to do this. Other times, if I'm in like wrap Bitcoin USDC, Ethereum USDC, I can take this capital, even SOL USDC, I could take the SOL, the wrap Bitcoin, the Ethereum, and I can hold it out. I could park it on Aave, MarginFi, or any other lending and borrowing platform, and ultimately I can borrow against it. So that way my capital isn't completely out of work, but rather it's over here as a hodl, and then I could borrow like 50% loan to value, and then I could take that 50% and park it in the pool again, right? There's so many strategies that I can execute here. These are the more advanced strategies. These do not mitigate this divergence loss, but they help with it, right? They help you recover. They're more recovery plans than anything, if that makes sense. But these guys right here are going to help you mitigate divergence loss. Guys, if you enjoyed today's video, make sure to drop a like, subscribe, notifications turned on. Let me know what type of content you guys want to see on the channel down below in the comment section so I can make some more of it for you, explain some hard to learn topics. And if at any point in time you guys need some help implementing a strategy like this or helping mitigate impermanent loss, then feel free to reach out. There's a link right below this video. There's no pressure whatsoever, just if you're serious about DeFi investing and you want some outside help. Hope you guys did enjoy, and I will see you guys in the next one. Peace out.